Somewhere in San Francisco right now, there is a founder sitting in a conference room that used to be full of engineers. The desks are empty, the Slack channel has gone quiet, and on a laptop screen in front of them is a tweet from OpenAI announcing a new feature. A feature that does, for free, in one click, exactly what their company spent 3 years and over $100 million in venture capital building. That is not a hypothetical. That is happening right now, in real time, across dozens of startups that raised 9 figures on the promise that they had built something OpenAI would never bother to build themselves. They were wrong. And today I am going to show you exactly how it happened, which companies are already dead, which ones are next, and why the founders who are panicking right now had every reason to see this coming and somehow didn't. A quick word before we get into it. I've spent the last several years doing nothing but tracking the AI industry's casualty list. Every shutdown, every acqui-hire, every quiet layoff announcement buried in a Friday afternoon blog post. I read the SEC filings, I read the CB Insights data, I read the leaked Slack messages when they surface. That is the lens I am bringing to this video. Everything here is sourced. I will tell you clearly what is confirmed reporting and what is informed analysis, and I will never blur the two. Let's get into it. To understand what just happened, you have to understand the business model that an entire generation of AI startups was built on top of. It is called a wrapper. And for about 18 months, it was the fastest way to raise venture capital in the history of Silicon Valley. Here's how it worked. OpenAI releases a powerful model through an API. A founder builds a clean interface on top of that model, targets a specific use case, adds a subscription price, and calls it a startup. Write marketing copy, summarize PDFs, summarize PDFs, summarize PDFs, generate logos, build a personal assistant. Thousands of companies did exactly this between 2023 and 2025. Analysts at CB Insights tracked over 14,000 new AI startups launched globally in 2024 alone, most of them thin interfaces sitting directly on top of somebody else's foundation model. For a while, it worked beautifully. Venture capital poured in. One widely cited estimate puts total 2024 AI startup funding at $67 billion. Valuations soared on the strength of a demo and a growth chart. Headlines called every third one of them the next OpenAI. Then the floor started to give way. And here is the number that should terrify anyone still building a wrapper business in 2026. Independent trackers now estimate that roughly 40% of the AI startups that launched in that boom have shut down within 24 months. Not pivoted, not restructured, shut down. That is not a normal startup failure rate. That is a specific, structural, predictable collapse. And the mechanism behind it has a name inside the industry now. People call it getting Sherlocked, a term that goes back to Apple quietly killing third-party Mac utilities by building the same feature into the operating system for free. OpenAI has weaponized the exact same playbook, except it is happening at a speed and scale nobody in the Apple era ever had to deal with. Let me walk you through exactly how the kill shots have landed, one release at a time, because the pattern is not subtle once you see it laid out chronologically. Custom GPTs launched, and every build-your-own AI assistant startup lost its entire pitch overnight. ChatGPT Enterprise shipped, and SaaS companies that were reselling team access to the API watched their customer base evaporate in a single product announcement. Code Interpreter arrived, and data analysis wrapper tools that charged monthly subscriptions for what was now a built-in ChatGPT feature had nothing left to sell. Function calling and agent tooling shipped, and an entire wave of AI agent orchestration, startups that had raised seed and Series A rounds on the premise that this was hard, specialized infrastructure, discovered it was now a checkbox in someone else's developer console. This is the part most people watching from the outside do not understand. OpenAI is not trying to kill your company when they ship a feature. They are trying to make ChatGPT more useful. Your company just happens to be standing exactly where that usefulness needs to go. There is no malice required. That is what makes it so brutal. You cannot negotiate with a product roadmap that was never built with you in mind in the first place. I want to move from the abstract pattern to the specific companies, because the abstract version is easy to nod along to and forget by tomorrow. The specific version is what should actually keep founders up at night. Start with Jasper AI. At its peak, Jasper was one of the most celebrated AI companies outside of OpenAI itself. It had raised well over $100 million in venture funding, hit a valuation north of $1 billion, and was widely treated in the press as proof that a company could build a real, durable business on top of GPT-generated writing. Jasper's entire product was AI-assisted marketing copy, blog posts, ad copy, product descriptions, at scale, for a subscription price. And then ChatGPT quietly added the ability to write long-form content directly, for free, inside a product that hundreds of millions of people already had open in another tab. Reporting on Jasper's trajectory since has described revenue declines of around 70% from its peak, alongside a pivot away from its original consumer writing product toward enterprise workflow tools. The standard survival move for a company whose original reason to exist has been absorbed by the platform it was built on top of. Copy.ai followed a nearly identical arc. Marketing copy generation, tens of millions raised, real customers, real revenue. Multiple reports through 2025 described layoffs and a strategic pivot toward broader workflow automation, moving away from the core copywriting product that made the company's name in the first place for the same underlying reason as Jasper. The thing they were selling became a free feature of the thing everyone already had. Writesonic, another SEO and content generation startup in the same category, shut down its consumer-facing product entirely according to industry trackers, retreating to an enterprise-only model, which in this industry is often the polite, investor-friendly way of saying the mass-market version of the business no longer works. And then there's the one that should really make founders uncomfortable, because it did not even come from a competitor. It came from OpenAI killing its own product. In late March of 2026, OpenAI shut down Sora, its standalone text-to-video app, alongside the API that powered it. In late March of 2026, OpenAI shut down Sora, its standalone text-to-video app, alongside the API that powered it. Sora had launched to enormous hype, the kind of demo reel that makes an entire industry recalibrate what it thinks is coming next. At its peak, it reportedly crossed roughly 1 million users. By the time OpenAI pulled the plug, usage had collapsed to under 500,000. A previously reported billion-dollar partnership discussion with Disney reportedly fell apart around the same period. OpenAI's own leadership, according to a journalist reporting cited widely at the time, told employees the company was actively looking at which areas to deprioritize as it refocused resources toward coding and enterprise products. Read that sentence again. This is the same company that has cannibalized over 200 funded GPT wrapper startups with its product releases, and it just cannibalized its own flagship video product because the math did not work even for OpenAI itself. If the company with unlimited Microsoft-backed capital and direct access to the frontier model cannot make a standalone AI video product survive its own burn rate, what exactly did every smaller, thinner margin startup building on the same foundation think was going to happen to them? Character.ai is the other case worth understanding, because it shows the alternate ending to this story, the one where a founder sees the wall coming and jumps before impact. Rather than watching the company slowly bleed out competing against a platform that could always out-resource them, Character.ai's leadership executed a deal that folded key talent back toward Google, the kind of outcome now commonly described in the industry as a talent acquihire, a soft landing that protects the people even when the independent company version of the story ends. Then there's the category nobody talks about enough because it does not produce a dramatic shutdown headline. It just produces a slow, quiet bleed, the file and document wrapper category. Back in November of 2023, OpenAI shipped a simple file upload feature directly into ChatGPT. Overnight, dozens of ChatGPT for PDFs startups, companies that had raised real seed and Series A money specifically to let you upload a document and ask it questions, lost their entire reason to exist. No press release, no acquisition, no dramatic founder interview. Just a slow decline in signups that showed up in the metrics dashboard a few weeks later and never recovered. That is arguably the most common version of this story. It is not always a public flameout. Sometimes it is just a company that quietly stops posting on social media, stops responding to press inquiries, and eventually lets its domain lapse. And then there is the AI agent orchestration wave, which deserves its own mention because it is the most recent version of the exact same pattern, just moved one layer up the stack. Through 2025, a wave of startups raised funding specifically to solve the hard problem of getting multiple AI models to coordinate, hand off tasks, and act autonomously across tools. It was pitched as genuinely difficult infrastructure work, the kind of thing that would take years to commoditize. OpenAI shipped native agent tooling and visual workflow builders directly into its developer platform within months. Some of those agent orchestration products were deprecated by OpenAI itself less than a year after their own splashy dev day launch. A reminder that even the features OpenAI ships to kill outside competitors are not guaranteed a long life inside OpenAI either. The pace of the entire category is now measured in months, not years, and every founder in this space knows it, even the ones who won't say it out loud on a podcast. Before I get into the part of this story that I think is the real headline, why the founders who are panicking right now had every warning sign available to them and built the wrong company anyway, I need to ask one thing. If this breakdown is giving you the layered, sourced version of the AI industry that you are not getting from a 5-minute tech news clip, hit subscribe and turn on notifications right now. This industry is producing a new casualty roughly every single week, and I am tracking every one of them with this same level of depth. You do not want to be catching this story 3 weeks late from someone repeating a headline. Stay subscribed and stay ahead of it. Here's the uncomfortable truth. And as someone who has watched this pattern repeat itself dozens of times now, this is the part I think deserves the most honest treatment. Almost every founder who built a pure wrapper company in the 2023 to 2025 window was making a bet, whether they said it out loud in the pitch deck or not, that OpenAI would either be too slow, too distracted, or too uninterested to build the specific feature they were selling. For a narrow window, that bet paid off. OpenAI was moving fast on the model layer and comparatively slow on shipping consumer-facing product polish. That gap was the entire opportunity. But that gap was never going to last, and the venture capital community knew it even while writing the checks. One investor, quoted describing the dynamic bluntly, put it this way: OpenAI weaponized pricing, and every API wrapper startup became a zombie company, still operating, technically alive, but with no realistic path back to health. The economics explain exactly why. A typical wrapper business runs on 20 to 40% gross margins because it has to pay OpenAI for every single API call while charging its own customers on top of that cost. When OpenAI cuts its own prices, which it has done repeatedly as inference costs have fallen roughly 80% between 2023 and 2025, according to multiple industry cost analyses, the wrapper's customers expect a matching price cut immediately. But the wrapper's own costs do not always fall at the same rate, especially as usage climbs. The result is margin compression down into single digits, a business that is technically generating revenue and is nonetheless mathematically unsustainable. This is not unique to small startups either. Even OpenAI's most serious, well-funded competitors have felt this pressure directly. Anthropic has had to cut prices dramatically to stay competitive while still working to grow market share against a competitor with a massive built-in user base. Cohere and AI21 Labs, two of the earliest well-funded foundation model companies, both scaled back or shut down elements of their public-facing API business as the pricing war intensified, pivoting toward enterprise-only positioning, where relationships and support matter more than raw price per token. If companies with hundreds of millions or billions in funding and their own proprietary models felt this pressure, a thin interface with no data moat, no proprietary model, and no defensible technology was never going to survive the transition from clever idea to commodity feature. The founders who are panicking right now are not panicking because something unpredictable happened to them. They are panicking because the thing that was always going to happen happened on their specific week, to their specific company, after they had already spent the runway telling employees and investors it would not. I do not want to end this on pure devastation, because there is a real important lesson buried in who does not end up on this list. And it matters if you're building anything in this space right now or investing in someone who is. The startups that are surviving this wave share a small number of characteristics, and none of them is, we use a better prompt. The first is a genuine data flywheel, a product where every single customer interaction makes the system measurably better for the next customer in a way that a competitor starting from zero cannot simply copy by shipping a similar feature. The second is deep workflow integration, being so embedded inside how a customer actually works, connected to their existing tools and processes, that switching costs become the real moat instead of the AI model underneath. The third is genuine distribution advantage, existing relationships and existing customer trust that a feature announcement from OpenAI does not erase overnight. The fourth is brand, in categories where trust and reputation take years to build and cannot be replicated by a changelog entry. And the fifth is a real network effect, where the product gets more valuable as more people use it in a way that compounds rather than resets with each new competing feature release. Notice what is missing from that list. We built a clean UI on top of GPT is not on it. We were first to market with this specific use case is not on it. Analysts covering this exact failure pattern now project that as much as 80% of pure AI wrapper startups will fail by the end of 2026. And the number that should actually matter to you is this one. OpenAI's own product releases alone have already cannibalized more than 200 funded wrapper companies in a single year. Not the whole industry combined. OpenAI on its own, with its own roadmap, moving at its own pace. Step back from the individual company names for a second, because the strategic picture here is bigger than any single shutdown announcement, and it is the part that I think gets lost in the day-to-day tech news cycle. OpenAI currently controls somewhere around 87% of consumer AI usage by most third-party measurements, with several hundred million monthly active users against competitors, measured in the single-digit millions. When someone outside the industry says, "I asked AI," in the overwhelming majority of cases, they mean ChatGPT specifically, not the category in general. That is not just a market share number. That is a distribution advantage so large that it changes the entire calculus of what counts as a defensible business built on top of it. Every feature OpenAI ships does not just add a capability. It resets the baseline expectation for what AI means to hundreds of millions of people simultaneously. And every startup whose value proposition sits below that new baseline becomes invisible the moment the update rolls out, whether or not the founders ever get an email telling them so. And here's the twist that I think is the most important insight in this entire story. OpenAI is not even immune to its own gravity. The same company that has quietly ended the writing wrapper industry, the summarization wrapper industry, the basic agent orchestration industry, and dozens of individual product categories along the way, shut down its own video product because the compute economics did not work even with essentially unlimited backing. OpenAI is reportedly forecasting billions of dollars in losses this year, even as revenue climbs, and reporting has described internal leadership turnover and pressure to sharply prioritize where the next dollar of infrastructure spending actually goes. This is not a company that is invincible. It is a company that is currently powerful enough to kill almost anything built directly on top of it, while simultaneously not being profitable enough to guarantee that every one of its own bets survives either. That combination, massive platform power paired with real internal financial pressure, is exactly the environment that makes predicting the next 12 months of this industry so difficult, and exactly why founders who are still building thin layers on top of someone else's model should be paying very, very close attention right now. For the founders currently living through this, the read is brutally simple. If your product can be described in one sentence as a nicer interface for prompting a model that already exists, that sentence is not a business plan. It is a feature request sitting in someone else's roadmap, waiting for its turn. The only real question left is whether it gets built this quarter or next. There is also a quieter, second-order effect rippling through the venture capital world right now that does not get nearly enough attention in the day-to-day coverage. Every one of these shutdowns is not just a founder's personal loss. It is a limited partner's capital, a Series A lead's reputation, an early employee's equity that just went to zero, and a handful of junior VCs who staked their internal credibility on a deal memo that confidently argued this specific wrapper had a moat. Multiply that by 200 plus companies cannibalized by OpenAI's product releases alone, and you start to understand why term sheets in this category have gotten dramatically more skeptical over the past year. Investors who were writing seven-figure checks off a slide deck and a demo in 2023 are now asking, on the first call, the exact question that should have been asked from the very beginning. What happens to this business the day OpenAI ships this exact feature for free? If the founder does not have a real answer, the meeting is over. That single question, more than any regulation or market correction, is what has quietly reshaped how AI startups get funded going into the second half of 2026. Two things before you go, and I mean both of these directly. First, if this breakdown gave you something you are not getting from the standard 5-minute tech headline cycle, share it right now with one person who is building something in this space or investing in someone who is. This kind of layered, sourced analysis only reaches the people who actually need it if the people who find it first pass it along. Second, I want your read in the comments. Which category do you think gets Sherlocked next? Coding assistants, customer support agents, personal productivity tools? Is there any wrapper business model left that you think is actually safe long-term? Or is the entire category a countdown clock? Drop it below. I read every single one, and if this delivered real value, hit like before you go. Here is where this stands. An entire generation of AI startups was built on a bet that OpenAI would stay too slow or too distracted to build the exact features they were charging for. That bet held for a short window and then collapsed catastrophically, with independent trackers now estimating roughly 40% of AI startups from the 2024 funding boom shut down within 24 months. Jasper AI, once valued north of $1 billion, has seen revenue collapse by an estimated 70% from its peak and has pivoted away from its original product. Copy.ai and Writesonic followed similar paths, retreating from the consumer products that made them famous. OpenAI shut down over 200 funded wrapper companies through product releases in a single year, then turned around and shut down its own billion-dollar hyped Sora video product for the exact same underlying economic reason. The margins simply did not survive contact with reality. Meanwhile, OpenAI itself now controls roughly 87% of consumer AI usage, a platform gravity so large that it resets what an entire industry has to compete against every time a new feature ships, while facing billions in its own projected losses and internal pressure to cut projects that do not pay for themselves. The founders who are panicking right now are not victims of bad luck. They built companies with no moat on top of a platform that was always going to eventually build the same thing for free. And the only real surprise left is which specific week the email announcing the new feature was going to land in their inbox. Stay locked in, because this list is not finished growing.